Welcome back. You're still tuned into Trading Hour. We're just above the 20,000 mark once again on the Nifty. So we've moved back into the green, but the mid-caps continue to see a lot of pressure. Still around 80 points in the red right now. So 320 points gone over there. The small caps, micro caps also, like we were mentioning, have all pulled back a fair deal. But let's get you a conversation going now on the markets and some individual stocks as well. Siddhartha Khemka joins us, Head of Retail Research at Motilal Oswal Financial Services, to take some questions now. Siddhartha, as always, thanks a lot for being with us. I just want to get straight to the stocks. I know that you do look at Raymond. So tell us what you expect now, because the festive season is starting. So tell us what you expect in terms of the demand coming through, and what makes you positive on this specific count.
Yeah, very good morning, Pavitra. If you look at Raymond's, what they have done in the last few years is not only they have brought in a lot of focus in terms of the business. They have also, the management has strengthened the top leadership team, and they have also restructured its group. So to bring clear focus into two segments, the retail business and the real estate. And they have kind of demerged or hived off the FMCG business. So to bring clear focus, if you look at the core strengths for Raymond, it lies in its well-established brands, be it Raymond's, Park Avenue, Color Plus, Ethnics, which it now plans to grow through a asset-light or a capex-light franchisee model. And you look at what has happened to some of the other retail players, be it Trent, ABFRL, they have all done well. There was definitely in the last few quarters, we have seen some kind of slowdown in the discretionary demand, but that is again picking up. And with the festive season ahead, we believe that the retail demand would again pick up. In the real estate business, they have done very good execution. They have incubated the real estate business in the Thane region. Demand has been pretty strong for whatever they have launched so far. The management wants to now expand to other regions, taking their learnings and experience from Thane. So that are in terms of the growth drivers for the key business. If you look at overall valuations, the stock still trades, after having moved up significantly in the last 1 year, still trades at a very significant discount to the peers. If I were to value the real estate business at 5 times EBITDA, the retail business that is left out is trading at about 15 times FY25 on a PE basis, which is a stark discount to some of the established players which are trading at 45-50 times on a forward earnings basis. So we see enough room, headway for even the valuations to kind of move up. So we are kind of valuing it at 22 times for the retail business, 5 times EV/EBITDA for the real estate business, which gives us a SOTP target price of 2,600, which is a good upside from current odd levels.
You said valuations are cheaper than peers. Do you want to tell us a little bit more about the peer comparison?
Yeah. So as I was telling you, so these are two separate businesses. You have to look at them separately. The real estate business, we are looking at a much, you can say, at a lower valuation given the small size at 5 times EV/EBITDA, which leaves the retail business at about 15 times FY24. The retail business is seeing a strong growth of about 18-20% on a net earnings basis. And we believe that at 15 times, it is much lower compared to some of the established players, be it Trent or ABFRL, which are trading at much higher valuation there. Definitely the earnings growth and pickup is much better, but they are trading at 45-50 times on FY25 compared to Raymond's retail business, which we believe is trading around 15 times FY25. So that gives us a good headroom for upside, where they are kind of focusing strongly. The growth is being driven by asset-light model to the franchisee mode. So return ratios will see a sharp improvement over the next few years. And that should lead to the re-rating that we are expecting in the retail business.
Okay, that is Raymond's. Interesting. Siddharth, hi, good morning. It's interesting, right? You still got some mid-cap stocks on the radar that you like despite the rally. And I think that's what the market would want to look at, those ideas. I'm looking at the next stock on your list, which is CAMS, Computer Age Management Services. Now, again, interestingly, this stock hasn't rallied. I mean, it's just hardly 15-16% up in 2023. It's actually very flat for the last 12 months. What's your thesis on CAMS? Why do you like it?
Yeah, so if you look at what has happened in the market, especially in the mid-cap space, the market has been quite optimistic on the capex theme, the public sector enterprises, which to some extent does not offer the risk reward for new entry at this moment. I don't feel that there is the story has changed. The long-term structural story there continues, but at this juncture, what are the space or sectors that could do well, especially in the mid-cap space? The market-related or capital market-related stocks is something that we feel should do well with the market now moving up, Nifty crossing 20,000, the mid-cap, small-caps at all-time highs. So CAMS is a space where they had an analyst meet recently. It's a market leader in the MF registrar and so RTA industry with almost 70% share. What is exciting is that their growth in the non-MF segments, such as the AIFs, PMS, insurance repository, the payment aggregator business, so that is showing a strong growth, which we believe would kind of grow higher than the MF RTA business. And that is where we believe that the stock not only gives a stable growth opportunity, it's a kind of value plus an annuity business model in this environment where it will give a kind of stability to the portfolio. Again, if you look at, as I said, EBITDA margins have been ranging in the 43 to 45%. That gives enough margin levers for the company. And the non-MF business, the contribution is expected to increase from 10% to 15% over the next 2-3 years with a higher margin trajectory. Currently, we have a buy rating with a target price of 2,850, which would be valuing the stock at about 35 times on FY25 PE basis.
Okay, got that. Siddhartha, thanks a lot for joining us and taking us through these two ideas, that is Raymond and CAMS. We hope to have you back on the show very soon. For now, we do need to take a short break, but I do want to point out that, you know, the mid-cap index has recovered significantly from the lows. So it's up around 310 points from the lows. The small caps have recovered even more. So it's a near 1% kind of recovery that you've seen on the small cap index. It's just around 0.2% in the red right now. So it's all about the market action. We're going to take a short break and come right back. And on the other side, we'll have Mitesh join us for a quick technical check and some fresh trading ideas as always.